Well, Russell Jones is head of fixed income strategy at Westpac. He joins us now from Sydney. Russell, very good to see you. What happens if these talks do drag on into July?
I think probably the markets will be patient for some time. I think that we're unlikely to see things really coming to a disastrous end over the course of the next few weeks. But it is going to leave things very uncertain. I certainly don't think there's going to be an improvement or any dramatic improvement in spreads over that period. But I don't think we're going to get a catastrophic outturn just because this is being pushed a little bit further down the road.
You say that a soft default, the Vienna-type solution initiative here being discussed for Greece could end up being the worst of all worlds. Why do you say that? Well,
really it doesn't address the underlying problem. I think that a soft default still leaves Greece's debt dynamics in a really in an unsustainable way. It doesn't really bring down the level of outstanding debt to a dramatic degree. Greece will still have to push through this extended period of real eye-watering fiscal consolidation, and it's going to have to do that with very little economic growth, and that's a terribly difficult thing to do. What we know from history is that governments which have managed to consolidate their finances when they've had similar problems, they've required lower interest rates and they've required a weak exchange rate. And that's the one thing that the peripheral countries in the Eurozone really can't depend on at the moment. The Euro's strong because of the problems that the dollar has, and also the ECB is pushing rates up rather than pushing them down. It makes this a terribly, terribly difficult set of circumstances for the Greeks to deal with.
Yeah, these are the inherent conflicts within the Eurozone project. But what other alternative do you suggest? What should they do here?
I think there are a number of other alternatives. First of all, let's just take the Greeks and all the other peripheral economies out of the market effectively for a very long period of time, maybe up to 10 years if necessary. Let's do that as a starter. Perhaps a better alternative than the soft restructuring would be to repeat the so-called Brady bond plan that was used back in the 1980s for some of the lesser developed economies as well. For that to happen, you'd need the EFSF to be able to buy bonds in the secondary market and then basically swap them for bonds that they issue themselves. That might be something which I think has rather more, or can offer rather more traction than the current strategy which is being put forward. But ultimately, you know, the bottom line is that we need growth. And if we don't get growth, really, it's very unlikely we're going to get a happy ending at all with this story.
Russell, is it worth doing all this? It all seems very, very difficult, a lot of pain. Why not just let Greece go, make an example of them, bail out the banks, and get on with it?
I think that the problem is that it's the so-called law of unintended consequences. We really don't know what would happen if there was a hard default or if Greece left the Eurozone. You know, what degree of contagion would that generate? How many other countries would be sucked into a similar situation? Would the entire Euro project unravel? What would happen to the ECB's balance sheet, which is at huge risk at the moment? There are all these imponderables out there, and it just means that maybe you know, the default option, as it were, is actually more painful than going through or trying to go through this process that we're facing at the moment. The bottom line is it's extremely uncertain where we end up in this crisis. Very hard to predict. All I can offer is a prediction that there will be continued instability, volatility, and it's going to be very painful for the population of those countries which are most in the midst of this crisis.